Orderflow legs are potentially the most powerful concept that a trader can add to their toolkit when it comes to understanding which directional bias the market is currently favoring on a multi-timeframe basis, making it easy to quickly filter the high-quality FVG and iFVG setups from the ones that should be avoided, whilst also providing us with clear, immediate liquidity targets for each trade. So, in this video, we are going to cover what orderflow legs are, how we use them to read the directional bias of each timeframe of a chart, as well as the criteria we use for pinpointing the highest probability FVG and iFVG trade setups. So let's waste no time and move on to the first step, which covers the definitions and criteria for both order flow and order flow legs. Here we have a bullish uptrending structure, which we can also categorize as bullish order flow. And the reason why is because each of the swing highs are being broken through to make new higher highs, whilst on the other side, the swing lows are being respected to make new higher lows. But more importantly, we can also see that each bullish fair value gap that had formed within this price action was respected and used as an area of support, creating a cycle which resembles a rising set of steps where the market is pushing up and through a swing high, before then retracing back down and finding support in a bullish fair value gap, which it then uses as the fuel to attack the next swing high. And then we also have bearish order flow, which is where the market is moving in a downtrending structure. And as we can see, the market is again using the internal range liquidity areas as resistance, which are the bearish fair value gaps, in order to target the external range liquidity levels, which are the swing lows. So, to give an actual definition for the concept of order flow, it's the name of the process of when the market is delivering the price from one liquidity pool to another, whilst remaining within a trending structure. So in the case of bullish order flow, this would involve the market respecting bullish fair value gaps in order to target the consecutive swing highs. Whereas for bearish order flow, it's the opposite, which is where the market is respecting bearish fair value gaps in order to target the consecutive swing lows. So this is a basic explanation of how order flow works, with the patterns of how the market typically interacts with fair value gaps and swing points depending on which direction it is looking to move in. But the real benefit of being able to read a market's order flow is found within the concept of what we call order flow legs, which can help a trader to assess the strength of a move in real time to determine whether the market is more likely to continue respecting the trend or create a shift towards the other direction. So to show how this works, here we have two bullish price legs, with both containing a swing high and a swing low. But whilst they may look similar, the key difference between these two price legs is that within the leg on the left side sits a bullish fair value gap, whilst the leg on the right doesn't. And the presence of this FVG is what differentiates these two legs when it comes to how we determine their bullish strength, with the left leg being a higher probability bullish order flow leg, whilst the leg on the right is just a lower probability bullish price leg. So, just to be clear with how we actually define a bullish order flow leg before we go any further, there is three pieces of criteria that must be met. First of all, there has to be a swing low that establishes the start of the bullish leg. Secondly, the bullish move has to be impulsive, leaving behind a fair value gap. And then thirdly, there needs to be a swing high, which will act as the immediate external target if the market manages to respect the fair value gap. So with that covered, let's now take a look at how these two legs compare when it comes to being faced with a retracement move in the market. So starting with the left leg, when the market pushes down, there are two immediate PD arrays that it could potentially interact with, which would be the FVG or the swing low. And with the FVG being the first PD array that it encounters, the market is given the opportunity to use this liquidity pool as an area of support, resulting in the creation of a new bullish leg, targeting the latest swing high as its immediate draw on liquidity. But now, when we look at the price leg on the right, when the market creates a retracement move down, with there being no fair value gap, the only PD array that it can target is the swing low. So that's where we can expect the market is most likely to move to. So after this small demonstration, hopefully it now makes more sense why an order flow leg is considered higher probability than a regular price leg when it comes to continuing a trending structure. But this is still only the surface level. There is a whole lot more we need to cover in this video when it comes to understanding which order flow legs are worth trading and which should be avoided. But before that, let's just take a quick look at the bearish variant of an order flow leg, which acts just the same and follows the same criteria, but is instead used for downtrending structures, meaning we want to again see a swing high and a swing low, but this time we have a bearish fair value gap sitting inside the leg. And the idea is that when the market creates a retracement back up, this bearish liquidity pool can be targeted as an area of resistance, allowing for a new bearish leg to be created, with the latest swing low acting as the immediate draw on liquidity. And then on the right, we have an example of a bearish leg that contains no fair value gap. And like before, when the market moves up, the only PD array it has as a target is the previous swing high. So that's where we can expect it to move to, making it a much lower probability leg to trade in terms of bearish strength. So now that we have covered the idea behind the concept of order flow legs, we can move on to the next step. But before we look further into this, I wanted to quickly mention that we have just released our Smart Money Concepts TradingView Indicator package, which includes 3 customizable multi-timeframe indicators that implements over a dozen different concepts, including the order flow leg concepts you'll learn in this video, as well as all of the other concepts we have covered so far on the channel. And for a short time only, we are offering a 7-day trial period where you can test the indicators out for completely free, which can be found through the link in the description. So check it out at the end of the video if you're interested. So, with that covered, let's move on to the next step, which involves learning how order flow legs can signal which directional narrative we should prioritize, as well as how the magnet rule can help us to work out which fair value gaps are most likely to be targeted. When it comes to trading fair value gaps or order flow legs, one of the biggest mistakes that people make is failing to identify which direction the market's order flow is currently following. And this leads to people entering trades using low probability fair value gaps as their setups, which were never expected to hold. So, to explain how we can tell which directional bias a market is favoring, we will use this 15-minute chart, which contains a bearish 15-minute order flow leg. And at the current moment in time, because this is the latest order flow leg we have, our current directional order flow bias should be bearish. And the reason for this is because in order for a fair value gap to be created, it requires the market to create an impulsive move. And when the market acts impulsively, it's signaling its support for which direction it currently favors. Which, in simple terms, means that if the latest fair value gap that was created was bearish, we would hold a bearish directional bias. Whereas if the latest fair value gap was bullish, we would hold a bullish directional bias instead. But it's important to note that this rule applies to each time frame exclusively. For example, fair value gaps created on the 15-minute chart would only affect the directional bias of the 15-minute time frame and wouldn't affect the order flow bias of other time frames, like the 1-hour or 4-hour time frames. But we will look further into how order flow works on a multi-time frame basis later on in the video. So with this in mind, using the market structure of the chart we have here, we would currently be following a bearish order flow bias, which means we would expect that when the market retraces back up, it would target this bearish fair value gap as its draw on liquidity, offering an opportunity to create the next leg back down to attack the low of this order flow leg. However, this is just one potential outcome that we could expect to play out based on the context of the current market structure we have available. Because when we actually move forward in time to see what really happens, we see a new bullish leg form, which is less impressive in size, but within it lies a newly created bullish fair value gap. And with the forming of this bullish FVG, a new bullish order flow leg is now created. And this might bring the uninformed trader to a crossroads in the chart, because the market is now sitting between 2 different order flow legs with contradicting narratives, which means a decision has to be made. Do we just carry on with our original plan by targeting the bearish fair value gap? Or do we change our bias now that we have this new bullish order flow leg? Well, as we learned just a moment ago, we now know that when it comes to determining the directional order flow bias of a chart, we always prioritize the latest order flow leg, which means in the case of this chart, we should now switch our order flow bias from a bearish bias to a bullish bias. So now, moving forward in time, we do end up seeing the market move down into the bullish fair value gap, before then creating the next leg up, completing this bullish order flow leg. And this is because, when the fair value gap is touched for the first time, the target price is locked as the highest price that was reached during the bullish legs formation, meaning that if the market retraces down into the fair value gap and then manages to push past this high level, the order flow legs narrative is now considered complete. But it's important to remember that the market is still currently in a bullish order flow state, because interestingly, when this new bullish leg reaches the bearish fair value gap, although we consider it a low probability PD array because it isn't aligned with the current bullish order flow bias, it still appears that the market might actually be struggling to break through the resistance area. But this is a common interaction, and it's because there will still be unfilled orders from unsuspecting traders within this FVG area, which means that when the market interacts with PD arrays that aren't aligned with the current directional bias, we can still expect to see a small reaction, where it might slow the momentum down for a brief moment, like a speed bump. But in the larger picture, we don't expect these lower probability PD arrays to hold for too long, with the market quickly getting back on track with following its current directional bias. And now moving forward, a few more candles in time, we can see we have another example of where the market has created a new bullish order flow leg, which means in this current moment, if the market was to create a retracement move down, the first PD array that it would encounter would of course be this latest bullish fair value gap, which it can use as a support catalyst to attack the most recent swing high. But this is again only a trade idea based on the current market structure, because when we actually see how the move plays out, the bearish leg that is created happens to include a bearish fair value gap, meaning that we now have a new bearish order flow leg that again switches the directional bias of the market's current order flow, which signals to us that we should now be prioritizing this newly created bearish fair value gap as the higher probability FVG, and the bullish fair value gap that we were originally targeting is now considered the lower probability FVG because it no longer supports the current order flow narrative of the market. So the purpose of this demonstration was to show how we determine the directional bias of a market on a specific time frame using order flow legs. And whilst not every fair value gap will hold, this simple concept will help a trader to understand which FVGs should be considered for trade setups and which should be avoided. But there is also another very important rule that we must also consider when using order flow legs, which is what we call the magnet rule. So let's take a look at how it works. Here we have a small section of a chart on the 1-hour time frame, and as we can see, it contains a 1-hour bullish order flow leg. But when the market retraces down, instead of finding support within the bullish 1-hour FVG, it completely ignores it and instead pushes down and through the latest swing low, invalidating the order flow leg, which might be seen as a huge bearish indication signal. But immediately after this, the market creates a strong pullback move, blowing straight past the 1-hour FVG that was just invalidated, before continuing up to the swing high, which would have been our immediate target for this order flow leg setup. But what could have been the reason for why this happened? Well, when we zoom further out into the chart, we can see that just below this 1-hour order flow leg, there was actually another order flow leg, with the big difference being that this second order flow leg was created on the 4-hour time frame. And this is where the magnet rule comes into play, which is that if there are multiple PD arrays that the market can target, in this case being a 1-hour FVG and a 4-hour FVG, we can expect that the market will prioritize targeting the higher time frame fair value gap. But as a consequence, it means that the lower time frame fair value gap would be disrespected in the process. And the reason why this happens is because timeframes work on a hierarchy system, where the higher the time frame is, the more dominant and stronger its magnet is as a draw on liquidity. So in the case of this scenario, the market was drawn to the higher 4-hour fair value gap, which ended up being respected. But as a result, the 1-hour order flow leg ended up just being completely ignored, which is why you need to make sure you never tunnel vision into just one single time frame and stay aware of the higher time frame PD arrays that could potentially overrule the setups you might be targeting. But just to be clear, the magnet rule doesn't mean that this 1-hour order flow leg wouldn't have been considered a valid order flow leg before it was disrespected. It just means that when the market has the option of 2 targets, it's important to always be aware that the higher time frame option will always have the stronger magnet as a draw on liquidity. But the 1-hour fair value gap could still definitely have acted as a support area for the next leg up if it had the strength to do so by itself, without needing to have dipped lower down into the 4-hour FVG. However, just below the 4-hour fair value gap, we can find a second bullish 1-hour fair value gap. But unlike the other two, this fair value gap is not considered a valid potential target for support. And the reason being is that in order for the market to have reached this area, the retracement move down would have involved having to invalidate the 4-hour fair value gap. And in terms of the hierarchy, if the 4-hour FVG is invalidated, we would expect that the market would then be targeting the low of the 4-hour order flow leg as its next draw on liquidity, meaning that this lower 1-hour fair value gap should be ignored as it's being overruled by a higher time frame move. So to just be clear, if there are multiple bullish fair value gaps from different timeframes, the lower timeframe bullish FVGs can only be valid if they are positioned above any bullish FVGs from the higher timeframes. And this logic works the same for bearish fair value gaps as well, but it's just inversed, meaning that if there are multiple bearish fair value gaps from different timeframes, the lower timeframe bearish FVGs can only be valid if they are below any higher timeframe bearish fair value gaps that might be on the chart. And all of this might seem confusing to keep track of in real time, but we have coded the logic for both the directional bias rule and the magnet rule into our order flow trading view indicator, which is a part of our Smart Money Concepts indicator package that is currently free to use. So if you want to get access to it, a link will be found in the video's description. But now, going back to this chart one more time, if we now know that either of these two FVGs could potentially be the target for the market to find support, it means that technically the area of where we suspect a new leg to form would be made up of these two areas combined, which is quite a large area, which is not ideal for those wanting to use smaller risk-to-reward ratios for their setups. Which brings us on to the next important point that we need to cover, which is that to find the higher probability and highest ROI order flow leg setups, you always want to trade away from FVGs and not towards them. For example, as we just mentioned with this chart scenario, there is a large range of where we could expect a new bullish leg to form, and that's if the market even decides to respect one of the two FVGs. But there is another option, which is that we can wait for the market to create the retracement move, letting it decide and confirm what it wants to do, and then find a trade setup that follows that decision. So in this instance, the market targeted the 4-hour bullish FVG and successfully rejected off of it, which confirms to us where it intends to try and create the next bullish leg from. And then from here, we can now wait for a new bullish order flow leg to form on a lower time frame, such as the 1 hour, which we can then target for an entry setup. And the benefit to this is that we are now using a 1-hour order flow leg that has a much tighter entry setup that was created from the confirmation of the 4-hour order flow leg being respected. But the real advantage to this is that we know that the directional bias of this lower time frame order flow leg is also aligned with the directional bias of the higher time frame 4-hour order flow leg, which means that we now also have the opportunity to extend our target for this trade's exit to the target of the larger 4-hour order flow leg, giving us a much higher value trade if the 4-hour order flow leg manages to reach its completion target. So to sum this up, it's always considered a much higher probability setup to target a lower time frame order flow leg that was created as a result of a higher time frame fair value gap being respected, and then targeting the external range liquidity as a trade exit. And with this covered, we can now move on to the next step, which looks further into the different criteria we use to determine whether an order flow leg is high probability when it comes to trade setups. Here we have an example of a chart that contains a bullish order flow leg, but with added context, this piece of price action had attacked a higher time frame liquidity level before then pushing back up, creating the order flow leg that we are currently looking at. But additionally, this bullish leg also created a bullish CISD, which, if you are unaware of, is a PD array that is used for signaling a momentum shift in the market's directional order flow, which in this case is from bearish to bullish. And we have a whole video dedicated to CISDs that you can check out at the end of the video. But in this scenario, with the positioning of the bullish FVG overlapping with the bullish CISD, this creates a very strong bullish trade setup, because if the market was to retrace down into this area, the first contact would be with the bullish fair value gap, which in its own right could reject the move further up. But in the case that it continued to retrace further, it would then be faced with the strength of two overlapping areas of bullish support, making it far more likely that the market would reject towards the upside. And this would also be the case for if we had a bearish FVG that overlapped with a bearish CISD. The confluence of the two bearish PD arrays offers a much higher probability of the market rejecting from the resistance area. Now, as for the other piece of criteria that we use to determine whether an order flow leg is a higher quality setup, we already mentioned it earlier in the video, in that we ideally want to see the creation of the new order flow leg originate from the market respecting the fair value gap of a previous order flow leg. And this order flow leg layering can take place on the same time frame. But in terms of finding the highest probability setups, if the new order flow leg was created off of a higher time frame order flow leg, this would dramatically increase the confidence we have in expecting the new order flow leg to hold. So this covers the criteria for what makes an order flow leg considered a higher quality trade setup. But there is also another useful way that order flow legs can be used, which moves us on to our next step, which covers how order flow legs that contain iFVGs can be used for reversal setups. Here we have a 4-hour chart where the market has just attacked this old swing high, which was acting as the current draw on liquidity. And if we zoom in and go down into a lower 15-minute time frame, we can see that we have a bullish 15-minute order flow leg that was created during the attack of the previous high. And when we move forward in time, we see the market create a bearish retracement down, reaching the 15-minute fair value gap. But instead of finding support, the market instead continues pushing lower, with the candle closing below the FVG area. And it's in this moment that this bullish fair value gap now transitions into a different PD array, which is called a bearish inversion fair value gap, or a bearish iFVG for short. And what this means is that we can now expect the area that was previously a bullish fair value gap to act as an area of resistance if the market were to push back into it. So the benefit that this failed FVG setup gives to a trader is that we now have a new bearish setup that we could potentially use for a trade. And in the same way that a bearish order flow leg would work, we can use this bearish iFVG for a short entry, with the immediate draw on liquidity target being the swing low of the order flow leg. But this is only the immediate liquidity target, because if we believe that this liquidity sweep could act as the start of a market reversal, we can of course zoom out and take a look at the larger market structure to see the larger exit targets that this move could potentially aim for. For example, here we have a bullish 4-hour fair value gap, which is the next immediate PD array that the market would run into. So we have the option to use this as the larger target for this short trade. And as we move forward in time, we can see that the market did end up reaching this area. But instead of finding support, the market just continues breaking down, with the 4-hour candle closing below the area. And with following the same logic, this means that this bullish 4-hour fair value gap has now transitioned into a bearish 4-hour iFVG. So, in terms of where we might expect the market to move next, we can draw out the 4-hour order flow legs high and low, which can give us the immediate targets that we can expect the market to be drawn towards, which, in this case, was the swing low of the 4-hour order flow leg. And this is only a brief explanation for how iFVGs work, but the point is that order flow legs can be very useful for analyzing the current directional bias of a market's chart structure on each independent timeframe, offering clear immediate targets for both scenarios of an FVG being respected or disrespected. But there's a whole lot more to cover when it comes to iFVGs, which is why we have a whole video dedicated for this specific concept that will be clickable at the end of the video. And if you think these concepts would work well within your trading strategy, we have developed a series of powerful ICT TradingView indicators that implement the logic of everything you've learned in this video, along with all of the other concepts we have already covered on our channel. And for a short time only, we are offering a 7-day trial period where you can test the indicators out for completely free, which can be found through the link in the description. And if you found this video helpful, please leave a like and a hype, and comment which ICT concept you'd like to see us cover next.